Gold hit an all-time high of almost $4,400 this week before ultimately pulling back on Friday morning and afternoon and closed around $4,250, which is still a fantastic year-to-date number for gold. And I've been getting a lot of calls and emails about what I think about gold here. So I thought we would just do a little update on that. But before we get into it, I'm going to say that I think about gold much differently than many people. I try to stay as rational as possible about it. And the reason I laugh is because a lot of people get irrational, in my opinion, when talking about gold. And the funny thing is I feel like they get irrational for a very rational reason, is because when gold is at $4,200, that is telling you something is dramatically wrong, either politically, economically, geopolitically, socially. Something is wrong in the world if gold is up 50% for the year and at an all-time high. That is gold raising its hand and saying, hey, check me out because all is not well. And as a result of that, it is rational to kind of be irrational, right? If gold is saying, hey, you better take a look, then you should better take a look. But it's also the time where you need to, as much as you can, tamper down those emotions and think about it logically. So that's what we're going to try to do today. And we're going to try to just kind of walk through this in a logical manner. And I'm just going to tell you how I think about gold. You guys might think about it differently, but I'm just going to walk you through how I view it. And I'm going to do it in the context of the permanent portfolio. Because at the end of the day, when I think about gold, I'm thinking about it in relation to my own portfolio and my clients' portfolios. And as a result, it perhaps plays a different role for me and for my clients than it does for you. I think of gold as a wealth preservation tool. I do not think of gold as a get-rich tool. Now, some people may, and listen, if you discover a gold mine, and it pays you a dividend of gold for years going forward, then and you get rich as a result, that's fantastic. And I'm totally happy for you. That's just not how I think of it. Most of my clients have come to me because they have already done a great job of creating an overall portfolio and a huge net worth. And our job together is to figure out how to preserve and grow that over time. And I always use the permanent portfolio as a base case of what we could do or how to think about things going forward. Now, nobody ever actually does the permanent portfolio exactly the way it's laid out. But the point of it is, if you did do this and you did nothing else, you're never going to go broke, or you're probably never, you can never say never, but you're probably never going to go broke. And you're probably very, very rarely going to lose money on a yearly basis. In fact, this portfolio has only lost money 6 times in the last 50 years. And that is the goal that we're trying to set. How do we avoid the big drawdowns and participate in the upside? And this is what that portfolio looks like from 1970 to 2020. Listen, it's a few years old. I probably need to update this. But over that 50 years, they only lost money. This portfolio only lost money 6 times. And the most it ever lost was 12%. And that was in 2008 during a global financial crisis. Other than that, the most it ever lost was 4%. And as a result, you get a growth of portfolio over time that's pretty steady and up and to the right. And if the overall annualized return was around 9%, and if we would have just put it into some kind of a combination of both domestic and international equities, they probably would have beat this portfolio by maybe 1%, probably less than 1%, but maybe by 1%. But the point is this is just a very nice, steady way to try to grow a portfolio whose main objective is to protect the downside. And having gold is a huge part of protecting that downside. And part of the reason I kind of started using this as a base case is because after 2008, I decided that, and I see the source down here. It says IMF, Bloomberg, and JP Morgan. That's wrong for this slide. I'm not sure why that's on there. But after 2008, because I was doing this in 2008, I decided that you could no longer take all scenarios off the table. You literally had to be prepared for everything. And being prepared for everything ranged from a full recovery where everything was totally fine on one end and a total monetary system collapse on the other. And we kind of modeled out 4 different asset classes and how we thought they might react in these different economic scenarios. If you muddle through, maybe they all just kind of go up and down a little bit and nothing, really stands out. If we were to get into some kind of a deflationary scenario, then, equities and real estate probably don't do very well. Gold might do well, but it might go down initially, but then do really well. Bonds would probably do well in a deflationary scenario. In some kind of an inflationary recession or an inflationary depression, then you would expect real estate would probably do well, although it somewhat depends on what interest rates are doing. Bonds would obviously not do well. You'd want to stay away from them. Equities and gold would probably do fantastic in that scenario, and maybe equities would. In some kind of a recession with sovereign defaults, and this is kind of what we saw in Europe in the early 2010s, is you could see real estate fall, bonds kind of up or down, stocks go down a lot, but gold, and again in euro terms, perhaps did pretty well in the early part of it. Or if you have just a total monetary system collapse, and obviously you want to be out of all financial assets and you want to hold something like gold, real estate actually would probably do well in a monetary system collapse, although the currency value of it would obviously fall. But again, it was kind of thinking through all these different scenarios. How can we be prepared for all these different scenarios? And the permanent portfolio, or at least using the permanent portfolio as a roadmap, was a good way to address it. So that's how I think about gold. Now, this is kind of also, when I was thinking about these different asset classes, kind of came up with the whole milkshake concept. And again, the whole milkshake theory was my belief that because of all the debt in the world, we would get into a situation where the dollar would rise versus other fiat currencies, and that would have impact on other asset classes. And the impact on the other asset classes would be that bonds would fall, interest rates would rise, and U.S. equities and gold would rise as well. And if you look at this chart from when I first said that, that's basically what happened. Now, what didn't happen, what I thought would happen by 2024 and didn't, is I thought we would have a currency crisis. We got very close in 2022, but ultimately it didn't happen. Europe or England went into a very short-term crisis. Japan had a lot of trouble with both their sovereign bond and currency market. China's real estate collapse really accelerated during 2022. But ultimately, the Fed turned course. The dollar has fallen since that time, but it's still up 8 or 9% from when I first said it. So the asset class reactions have played out, just not to the extreme that I thought. But now we've seen gold just have a heck of a year this year, even though equities have had a really good year as well. Bonds have kind of gone sideways this year. But the point is that even though the crisis that I expected to happen didn't come to be, the framework was very helpful in allocating assets and understanding what was going on. And gold is a big part of that. Now, the other thing, and I know many of you have heard me say this 100 times, but in case there's anybody new, I'm going to say this again, is that the milkshake has never been anti-gold. Gold has always been a big part of it. And, there's numerous interviews where I've explained this in detail. And I think in the very first interview, I said gold will be the ultimate winner and gold will win in the end. But that did not mean that you needed to wait around for several years and own gold. I was very clear that everybody should own gold. What I mean when I say gold wins in the end, it just means it's the last one standing. But in the meantime, gold could do very well. Gold, and to me, nothing is more bullish for gold than the dollar going higher, because the dollar going higher actually wrecks the entire system. Part of the reason that gold is doing so well this year or over the last 2 years is because dollar did so much damage to the system in 2022. And this is the reaction to all that damage. But the point is that, I don't want anybody to think when I talk about the dollar, it is not anti-gold. Again, there's nothing more bullish for gold than a strong dollar. And I made it very clear in my very first presentation on this that, my gold thesis has never changed. I'm not going to go over this in detail. I've done this before. But, I said at the time the gold will go to at least $5,000 and probably a lot higher than that. We're not too far away from that at all. So again, when if I'm predicting that the gold is going to $5,000, that's obviously not bearish gold when I think gold was, $1,200 or $1,300 at the time. And again, I'm not going to go into detail on this, but essentially I said part of the reason that gold would go up a lot, I thought, would be driven by foreign buying. And again, that's exactly what we've seen since the dollar went up in 2022 and kind of caused all this chaos that happened in 2022. Foreign buying has been the main driver for gold going higher. And that brings us to this. And we touched on this chart a couple weeks ago, and I wanted to bring it back up again because I'm going to show you a couple other charts that I also think are important. Now, this shows that gold is rising as a percent of reserves and that U.S. Treasuries are falling as a percent of reserves. Now, part of the reason, there's a couple things that isn't explained really well on this chart. One of them is the part of the reason that the U.S. Treasuries are falling as a percent of reserves is because that figure is based on the price of bonds, and the price of bonds has fallen as interest rates have risen. The other thing is part of the reason that these lines are converging is because the reserve holdings of gold are based on price as well. And the gold price has gone up a lot. And so that is, now, this is not to say that they're not buying gold and they're not selling treasuries. I'm not saying that's not happened. That is happening at the margin. And I would argue the central banks are preferring to buy gold versus treasuries right now. But that doesn't mean that this is all based on actual holdings. It's based on price. But the other thing is I just want to point this out, that the major foreign holders of U.S. treasuries has never been higher than it is today. This is billions of U.S. dollars. This is foreign holders of U.S. treasuries. So it has never been higher than it is today. Now, the other thing, this is also based on price because the treasury tick data that gets published is based on market value. And this shows that it keeps going up. And this is despite the price of treasuries falling. So the point is there still have been buyers of U.S. treasuries. Now, I would argue that if interest rates hadn't been going down and if the world was a little bit safer place and there wasn't as much geopolitical uncertainty, they'd probably be buying more treasuries and less gold. So from that perspective, and again, that was part of the milkshake. The milkshake said interest rates would rise, bonds would kind of get rejected, and as a result, gold would be bought, equities would be bought, et cetera, et cetera. So I think we're seeing that, but I just want to point this out that it's not like the whole world is completely rejecting treasuries at this point. That could happen, but as of right now, it's not. The other thing is I wanted to share these charts. I just found these charts today, and they're great charts. And I knew this was the case, but I just hadn't gone through the process of calculating it. But basically what it shows is that world FX reserves and being held in gold, part of the reason is, again, a lot of the reason that the gold as a percent of reserves is rising is because of the price. It's not so much because central banks are out there buying tons and tons and tons of gold. They are buying gold and they are buying tons of it, but it's not like the whole world has just completely dumped treasuries and started to go buy gold. And that's why gold reserves have risen so much. A lot of it is tied to the price. And you can see that even better on this chart. This chart shows, and now the red line, this was what would happen if going back to 2009, if central banks had not purchased any new gold as reserves and the price did what it has done, that would be the red line. The blue line is the actual line, which shows the price plus the additional purchases of gold reserves. The gold line is what would happen if there had been no appreciation in the price. In other words, it's actually fallen. The actual holdings of gold ounces has fallen since 2009, but it's the price rising which makes the percent of reserves rise. Now, again, I'm not saying that the world wants all the treasuries and hates gold. I actually think it's largely the opposite. But this chart, I think, is very important to understand when you look at that. And here's the other thing. A lot of people, I already know how this goes. A lot of people are going to say, well, here's Brent, bad talking gold again, using these charts to show why the world doesn't want gold. And he's trying to show why this is bearish for gold. It's actually the opposite. I would argue that the fact that gold is at $4,400 or $4,200 and the central banks haven't even been buying all that much of it is actually incredibly bullish for gold. Because if you think about it, it's the difference between the red line and the blue line that has driven gold prices higher. If people really start, or if central banks really start to buy gold, it's going a lot higher than $4,400. So this is not me saying central banks are not buying gold. This is not me pointing this out in order to be bearish gold. I actually think it's the opposite. It just shows you that gold is a relatively small market compared to a lot of the others. And if those markets start to get rejected in favor of gold, it could push gold a lot higher. The other thing I want to point out is a lot of times when people talk about gold, they always talk about it in relationship to the US dollar. And that makes sense. The dollar is the global reserve currency. But when you talk about gold and how it's going to be used to dethrone the United States and bring down the United States empire, I don't get the argument of how gold is going to do that when the United States has more gold than anybody. And I already know how this is going to go. People are going to say, it hasn't been audited since whenever. Okay, fair enough. It hasn't been audited. When was the last time you saw the Chinese audit? And when's the last time you asked for it? When's the last time you saw the Russian audit? And when's the last time? In other words, why do you automatically accept all the other numbers on this chart, but you question the US one? Now, I'm in favor of questioning all of them. And I think you guys have maybe heard me say before, I actually think the US has more gold than they say they have. I think China has more gold than they say they have. But the point is I don't, if the world were to go back to some kind of a gold-based system, I don't think that singularly hurts the United States. And I think if that were to happen, the United States could be right there involved in using gold in the same way that the other countries use gold. So I don't see how gold brings down the American empire. But let's start talking about gold here a little bit, because listen, this has been an incredible move in gold. And this is almost a 40-year chart, 45-year chart. And the reason I put this on here is I wanted to show, you guys know I always like to look at the stochastics and the RSI and all this kind of stuff. But, gold is so far above this is a monthly chart. It's way above its moving averages on a monthly basis going back to the 80s. But gold is now as overbought. It's more overbought than it was in early 2021 post-COVID. It's more overbought than it was in 2009 and in 2013 before it went into a multi-year bear market. And it is as overbought as it was in 1980 when it then went into a subsequent several-year bear market. Now, this is not me saying that gold at this level means it's going into a multi-year bear market. I don't think that's the case. But I can't rule it out either. History says the last two times that gold made a move like this, it then pulled back and stayed down for a while. Now, again, before this gets put all over, Brent's calling for a multi-year bear market. That's not what I'm saying. I'm just saying this is typically how moves end, not typically how they begin. Now, there's a lot of people out there who think this is just getting started, and maybe it is. I would argue that people that think it's just getting started believe that we are now imminently in the end game. I don't think we're in the end game. I think this is still going to take several years to play out. But if this is the end game and the monetary system is about to come down, then yeah, gold is probably going higher. I just don't think we're there yet. And so as I think about gold at 42.50, I think about even if it's a 25% position in your portfolio, as the permanent portfolio suggests, that means that that's where it was at the beginning of the year. At this point, it's probably over 30% or up like 35%. So if you are ever going to do any rebalancing in gold, this is the time you would do it. Now, I'm not telling everybody to go out and sell their gold. That's not the point of this. And in fact, if you don't own any gold, you should go buy some. But the point is this is not the time to necessarily be adding if you already have it. And if you think of gold the way I do, as a protection of purchasing power, protection of lifestyle, and an overall wealth preserver, then this is the time to rebalance. If that's not the way you think of it, if you think of it as a way that you're going to get rich or really make your mark in the world or whatever it is, and you're willing to accept the risk that goes along with it, then that's a different way of thinking about gold than I think about gold. Now, let me just pull this up on a 5-year basis as well. Or no, this goes back to 2007 because I wanted to show the global financial crisis. Again, it just shows we are as overbought now as any time we have been since 2011 when it last peaked. And then this is over the last year. And again, it's as overbought as it's been all year. Now, the thing I'd point out is just because something is overbought doesn't mean it's going to fall, doesn't mean it's going to crash, and it doesn't mean you should go sell it. It just means that it's very, very high on a relative basis to where it has been. It can easily go higher. Again, back in the summer or back in the spring, it was around 2,800, 3,000, and it was overbought. It is now $1,000 higher. So it's not to say that it can't go higher. I'm just pointing out where things are. Now, here's the chart that I'm so interested in. This is the price again, and you can just see how this is going exponential, right? Again, if this is not the end game, then I would expect that line to come back down. Now, I don't think it's necessarily going to crash, but you would expect that line to come back down unless this is the end game and we're going to $20,000 because the whole world's going to end. But what I really find really interesting about this chart is because the U.S. government is shut down, this chart has not been updated. Now, typically, this is the commercial short position versus gold. And typically, you can use it as a reverse indicator. When one is really high, the other is really low. Now, the question I have is, as the price of gold has gone higher, now this is like 3 weeks delayed because the government is shut down. We don't have the updated number. I'm really curious whether this commercial short position is now the biggest ever or down here near the biggest ever, or if this big run up has been caused by the commercials throwing in the towel, covering their shorts, and therefore that's why it's going higher. And listen, I don't know the answer. I don't know the answer. I think for the most part, this drive up recently, it feels to me like has been driven more by physical buying than the speculators on the COMEX buying futures. But again, I really cannot wait for this to be updated because I'm really curious which way it's going. Now, oh, you know what I want to do? I'm gonna switch over here. Hold on, I'm gonna switch over. I'm just gonna pull up my screen on my Bloomberg, and we'll just. I mean, here's gold. You know, kind of. This goes back like a year or so. From a technical basis, I mean, this is not a bull. This is not a bearish chart. There's not a whole lot. There's no resistance. I mean, it's, you know, you go back forever and, you know, there's just no resistance anywhere because it's just kind of gone straight up. So what I did, I just went back a couple years, tried to look for a couple different support areas. You know, you could draw a line there. You could draw this one here. You know, if we were to pull up the moving averages, just to kind of get an idea, and we could draw a line there. You know, the 50-day moving average is down around 3680. Now, my guess is that over the next week or so, we're probably going to bounce around in this area. We've got a Fed meeting at the end of the month. My guess is that we're kind of either going to be a little higher or a little bit lower into the Fed meeting. And then at some point in the next couple of months, we're probably going to come back down, test 4,000 or maybe even the 50-day moving average. That is not necessarily bearish for gold. And I would actually say that would be healthy for gold, because if you continue going up in an the more something goes up exponentially, the harder the eventual pull down is going to be, because nothing goes up forever. I think that probably sometime before the year is over, we're probably going to be back down in here. Maybe. But here's the thing. even if it came back down and tested the 50-day moving average, that's still a fantastic return for the year. That would still be a 35% return for the year. And I would argue that would actually be healthy for gold. But I think whenever it happens, whether it happens this year, next year, at some point it will come back down and test one of these moving averages. I think that's going to be the real test of whether this is now a multi-year breakout or whether this was a one-time reaction and now we're going to go sideways for a little bit. And again, I don't know the answer. A lot of people that are talking about gold will tell you they know what's going to happen. They will tell you it's going to 5,000 and then 10,000 and then 20,000 and that it's a certainty. That could be the case. I don't know. I'm the first to admit I don't know what's going to happen. And the reason I own gold is I don't know what's going to happen. I can use history to kind of give me some guides. I can use my understanding of how the monetary system works to give me some guides. I can use my understanding of how the madness of crowds affects things, especially things that are as emotional as precious metals. But I don't know what's going to happen, and neither does anybody else. But what I do know is we've had a heck of a year in gold, and we're not recommending to our clients that we sell any gold, but we have already hedged some of it for some clients. And we think this is a prudent time to do so if you do that kind of thing. If you don't, that's totally fine. Again, this is not me being bearish gold. This is me saying, if and when you ever do something like that, this is the time to do it because everything is oversold overbought, and everything is extremely stretched, and nothing, not even gold, moves in a straight line forever. So if you own gold as part of your overall portfolio, I would encourage you to continue doing it. If you don't own any gold, then I would certainly go out and get some. And I wouldn't go out and buy it all right now. And if we get this pullback, which I think we will have at some point, then maybe that is the time to buy more. But I think if and when we pull back to one of these moving averages, or at least, the 4,000 range where we get a little bit of technical support, I think it's going to be really interesting to see what happens on that level. Now let's go back over here, because one of the things I just wanted to point out is a lot of people will say, again, the reason this is going up is because of, the dollar is so weak, and the dollar has been weak for the last couple of years. But it's still up versus all its peers over the last 4 or 5. And think about what has all happened over the last 4 or 5 years. How much stimulus there was, how much QE there was, all the bailouts. Why hasn't the dollar index fallen? Why hasn't it gone into the 90s or into the 80s and the 70s like many predict? I would encourage you to ask yourself that question. Why is the dollar index still as high as it is? If it's as bad as everybody says, why is it still at 98? Why isn't it 88 or 78 or 68? The other thing I would say is, this is the dollar in many ways has nothing to do with gold. The dollar going up versus foreign currencies is not bearish for gold. It could act as a headwind in a short time period. But again, the dollar going up versus foreign currencies is a huge pressure on the entire system. And that causes the system to come into question. And when the system comes into question, then gold raises its hand and says, here I am. And when the dollar went really high in 2022, and the U.S. in the West confiscated Russian reserves, and countries became questioning about, whether they're going to get sanctioned, they realized the strong dollar can cause a lot of problems. And I think that's partly why gold is doing so well right now. But again, the strong dollar wrecks the system. We don't have to go back to a gold standard for gold to raise its hand and say, hey, look at me. And I would argue that's what's happening right now. The fact that the dollar has not fallen versus foreign currencies over the last 4, 5, 6 years, is it causing problems for the rest of the world. And as a result, gold is saying, look at me. And if gold is saying, look at me, you should probably take a look. And if you don't own any, you should probably get some. But I would encourage you not to think of it as a get-rich-quick scheme. I would encourage you to think of it as a wealth preservation over long periods of time scheme. And if you think of it in that way, it doesn't really matter whether gold goes up or down. It's a strategic part of your portfolio. And the great thing about gold is the story on it never changes, because it doesn't have to change, because it's timeless and it's never different this time. Gold will pay off when it needs to pay off, and it will be there when you need it to be there. So that's it. One thing I wanted to say is remind everybody, we've got our our stablecoin paper and presentation coming out this week. If that's something, and we actually think that this has the potential to have a real impact on global geopolitics, and we'll explain why in the paper. But if you're interested in that, you can go to research.santiagocapital.com. You can sign up, and all of our subscribers will then, all of our paying subscribers will then have access to the presentation and the paper. So anyway, thanks for listening. Hope you guys have a great weekend, and we'll talk to you again next week.